Right now, oil prices are marching steadily toward $100 a barrel. In financial history, this specific price action acts as a classic late-cycle warning signal. It is tempting to think that number only matters to the energy sector, but $100 oil functions as a universal tax levied on the entire economy. Because oil is the baseline input for global commerce, this creates an immediate cost shock. Moving freight suddenly costs more. Operating heavy machinery costs more. Manufacturing basic goods gets expensive. Businesses do not absorb those expenses. They pass them directly down the supply chain to consumers. That is why rising energy costs translate instantly to higher prices at the grocery store and the retail checkout. When everyday living costs spike, consumer spending drops. This specific cascade effect has recently pushed the estimated probability of a U.S. recession up to 40%. Passive investing works well when energy is cheap and growth is easy. But in a slow-down environment, you have to make an active choice. Try to ride out the turbulence or restructure your portfolio to survive it. The reason you have to take defensive action yourself comes down to a macroeconomic dilemma known as the central bank trap. If institutions raise interest rates to fight 3.8% inflation, borrowing becomes expensive and the economy slows. But if they do nothing, inflation surges unchecked. Both paths lead to recession. This trap prevents central banks from printing money to bail out the market. A top-down bailout is off the table. Investors must now focus on objectively repositioning their own capital to protect their downside. To evaluate where to put your money, we can map asset classes on this matrix. We are looking at two specific metrics: how well an asset protects against inflation on the y-axis versus how well it defends against a recession on the x-axis. The first move is allocating 15 to 20% of your portfolio to the energy sector, focusing on established operators like ExxonMobil or Chevron. Since these companies sell the exact commodity that is getting more expensive, you create a built-in hedge. You capture the direct upside of the rising oil prices that are causing the broader economic slowdown. The trade-off is that energy is highly cyclical. If geopolitical tensions ease and crude drops back below $85, this specific allocation will immediately underperform. The second move focuses on the x-axis. This means moving 25 to 30% of your portfolio into defensive stocks, sectors like consumer staples, healthcare, and utilities. These sectors survive downturns by securing stable earnings and dividends. Even if disposable income drops, consumers still have to buy daily groceries and essential medicine. Holding these defensive shields comes with a distinct cost. You will sacrifice major bull market gains. You are explicitly trading explosive growth potential for baseline survival. Next, we look at holding 15 to 25% in cash equivalents, like high-yield savings accounts or 1 to 3 year Treasury ETFs. On our chart, this sits at maximum recession defense, but minimum inflation protection. Cash provides capital protection from market crashes. It guarantees your principal is safe while providing dry powder to deploy when asset prices eventually drop. But there is a mathematical paradox here. If inflation is running at 3.8% and your cash yields 4%, taxes on that yield ensure you are slowly bleeding real purchasing power. To protect the rest of your capital, you have to actively purge specific liabilities. That means dumping unprofitable tech, meme stocks, and weak crypto projects. Eliminating these speculative positions removes your exposure to the exact assets that are mathematically guaranteed to fall hardest when borrowing costs rise and market liquidity dries up. Selling these assets now might mean locking in a loss, but taking that psychological pain today is the only reliable way to prevent deeper, unrecoverable losses as the economic cycle tightens. When we combine these evaluations, we get a baseline template, the recession-ready portfolio. It breaks down into 30% defensive, 20% energy, 20% cash and bonds, 20% select growth, and 10% gold. That 10% allocation to physical gold or ETFs acts as a dedicated inflation hedge. Historically, precious metals perform exceptionally well during periods of maximum market uncertainty. We also retain a 20% allocation for select growth. You don't want to fully exit the market. Instead, you focus strictly on highly profitable companies with strong, verifiable cash flow. This model objectively insulates your money against severe downside risk. However, because it heavily caps your potential upside, you have to calibrate these percentages to your personal financial timeline. Let's apply this to a profile we'll call the wealth preserver. This represents conservative investors, passive indexers, or anyone within a few years of retirement. For this group, the primary lens is risk management. With a 40% probability of a recession, the immediate priority is avoiding the loss of principal. If this is you, the recommendation is to follow the baseline portfolio strictly: 30% defensive, 20 energy, 20 cash, 20 growth, and 10 gold, without deviation. By leaning heavily into cash, consumer staples, and gold, you insulate your capital from major market corrections and avoid the anxiety of a massive portfolio drawdown. You will not beat a raging bull market with this setup, but for the wealth preserver, buying sleep-at-night certainty is an entirely acceptable trade-off for capping your maximum upside. Now let's look at the opportunist. This profile covers younger, aggressive investors with a 10-plus year time horizon and fresh cash to deploy. If you fit this profile, treat that 20% cash allocation as your most aggressive offensive weapon. Holding a large cash reserve allows you to step in and buy deeply discounted selective growth assets when a severe bear market forces other investors into capitulation. To execute this, the opportunist has to accept the temporary inflation drag on their cash. Losing a little purchasing power in the short term is simply the cost of maintaining that dry powder. Oil shocks transfer wealth from the unprepared to the prepared. In a high-inflation, low-growth crisis, the best portfolios aren't aggressive. They are the ones structured to survive the squeeze, with the cash left over to buy the dip.